Key financial ratios. Welcome to MBA in a Can, where we simplify essential business concepts into clear and practical insights. In this financial management series, we're diving into the fundamentals of how businesses handle money, make investment decisions, and evaluate performance. Financial ratios are essential tools for evaluating a business's financial health, performance, and efficiency. By condensing complex financial data into simple metrics, they offer a clear picture of how a company is performing and help business owners, investors, and stakeholders make informed decisions. Ratios can be used to compare performance over time, against industry benchmarks, or with competitors, making them invaluable for strategic planning and financial analysis. Profitability ratios measure how effectively a business generates profit relative to its revenue, assets, or equity. For instance, the gross profit margin shows how much profit remains after covering the direct costs of goods sold. If a business earns $100,000 in revenue and its cost of goods sold is $60,000, the gross profit margin is 40%. Similarly, the net profit margin evaluates overall profitability by comparing net income to revenue, while return on equity, ROE, highlights how effectively shareholder equity is being used to generate profit. Liquidity ratios focus on a company's ability to meet its short-term obligations. The current ratio compares current assets to current liabilities, providing insight into whether a business can cover its debts due within the year. A ratio above 1 typically indicates financial stability. The quick ratio, often called the acid test ratio, excludes inventory to provide a stricter measure of liquidity, focusing on assets that can be quickly converted to cash. Efficiency ratios reveal how well a company utilizes its resources. For example, inventory turnover measures how many times inventory is sold and replaced over a period, offering insights into operational efficiency. Accounts receivable turnover, on the other hand, shows how efficiently a business collects payments from customers, indicating the effectiveness of its credit policies. Solvency ratios assess a company's long-term financial stability and its ability to meet debt obligations. The debt-to-equity ratio compares total liabilities to shareholders' equity, providing a sense of how leveraged the company is. A high ratio may indicate higher financial risk. The interest coverage ratio measures how easily a company can pay interest on its debt by comparing earnings before interest and taxes, EBIT, to interest expenses. Imagine comparing two companies in the same industry. One has a current ratio of 2.5 and a net profit margin of 15%, while the other has a current ratio of 1.2 and a net profit margin of 8%. At first glance, the first company seems more liquid and profitable, but further analysis might reveal higher long-term risks through its debt-to-equity ratio. Financial ratios provide a valuable starting point for deeper investigation and strategic decision-making. While financial ratios are incredibly useful, they come with limitations. They rely on the accuracy of the underlying financial statements, which may include assumptions or accounting methods that affect results. Ratios should always be interpreted in context, as industry norms and economic conditions can significantly impact their meaning. For example, comparing the profitability of a tech startup to a manufacturing company might not provide useful insights due to the inherent differences in their industries. This explanation is for educational purposes only and is not financial advice. Always consult a financial professional for business decisions, as ratios are just one part of a broader analysis. Understanding financial ratios can help uncover trends, pinpoint strengths and weaknesses, and ultimately make better informed decisions. For more on financial analysis, explore our videos on understanding financial statements and capital budgeting basics. For the rest of this video, we will provide a more comprehensive list of common financial ratios, categorized with brief explanations. These ratios offer insights into different aspects of a business's financial health, such as profitability, liquidity, efficiency, solvency, and market performance. While they are invaluable for analysis, They are most effective when used in context and combined with other financial tools and metrics. Profitability ratios. Gross profit margin measures the percentage of revenue remaining after deducting the cost of goods sold. Net profit margin shows the percentage of revenue that becomes net income after all expenses. Operating profit margin assesses the profitability of core business operations, excluding non-operating items. Return on assets, ROA, indicates how effectively a company uses its assets to generate profit. Return on equity, ROE, measures how efficiently shareholder equity is used to generate profit. Liquidity ratios. Current ratio compares current assets to current liabilities to assess short-term financial health. Quick ratio, acid test ratio, evaluates liquidity by excluding inventory from current assets. Cash ratio focuses solely on cash and cash equivalents relative to current liabilities. Efficiency ratios. Inventory turnover shows how many times a company sells and replaces its inventory over a period. Accounts receivable turnover measures how efficiently a company collects payments from customers. Asset turnover ratio indicates how effectively a company uses its assets to generate sales. Accounts payable turnover assesses how quickly a company pays its suppliers. Solvency ratios. Debt to equity ratio compares total liabilities to shareholders' equity to gauge financial leverage. Debt ratio measures the proportion of assets financed by debt. Interest coverage ratio evaluates the ability to cover interest payments with operating income. Market value ratios. Earnings per share, EPS, represents the portion of a company's profit allocated to each share of stock. Price to earnings ratio, PE, compares the company's stock price to its earnings per share. Dividend yield shows the annual dividend income relative to the stock price. Price to book ratio, PB, compares the stock price to the book value of equity. Leverage ratios. Financial leverage ratio assesses the proportion of a company's assets financed through debt. Equity multiplier measures the total assets per dollar of shareholder equity, reflecting financial leverage. Other key ratios. Free cash flow to revenue indicates how much cash flow is generated per dollar of revenue. Operating cash flow ratio evaluates how well operating cash flow covers current liabilities. Retention ratio shows the percentage of net income retained rather than paid as dividends. Dividend payout ratio represents the percentage of net income distributed to shareholders as dividends. Thanks for watching MBA in a Can. If you found this helpful, please like, subscribe, and share it with your friends and colleagues. Check the description for links to useful sources on the topic. See you in the next video.